James, how did the Harmony portfolios fare last month?
Well, September was another positive month for, most assets, to be blunt. And in those kind of scenario, you would expect the Harmony funds to post decent absolute returns. We've said it a number of times in these vodcasts, and again, September was a month where the entire range posted positive absolute returns. And in fact, with one exception, that has been the case for each of the last 4 months. And the one exception, Aussie dollar balanced, has been up the last 3 out of the last 4 months. So it has been a nice time to be in the markets.
Sounds very pleasing, James. What were the main drivers of performance during September?
As I said, really, it was quite broadly based, positive returns. Clearly, equity had a strong month, up over 3%. Emerging markets equity outperformed that, actually quite significantly. Again, clearly symptomatic of a risk-seeking mindset in the markets, if you like. Government bonds did reasonably well as well. Positive returns across the board, pretty much. Yields came in a little bit in the genuine safe havens like the UK and the US and elsewhere. Given the extraordinary monetary policy being undertaken in Europe, for example, yields came in materially, particularly in the periphery. So positive returns from government bonds generally. Investment grade rallied on the back of that. High yield and convertibles, the more risky end of the fixed income spectrum, also performed well, as one would expect in a month where equities are rallying.
Interesting. Did you elect to make any changes to portfolios last month?
We were reasonably quiet on that front this month. We've been reasonably active over the last few months as the market's ticking up to rein in the equity risk, start taking a bit of risk off the table. We also went underweight property securities a couple of months ago as these markets ran reasonably well. So we haven't done a huge amount in the portfolios over the last month. We've stuck with our positioning though, and obviously we balanced to target where appropriate. And so we maintain a small underweight to the equity markets, underweight government bonds, overweight credit and the higher risk parts of the credit market, underweight global property securities, and slightly overweight cash.
Finally, James, looking forward, what can our investors expect?
Well, it's nice to have had a decent run in the markets and a higher degree of positive sentiment around generally. We mustn't get carried away. We mustn't let that go to our heads too much, though. We've got to remain grounded and aware of the fact that there are clearly a lot of risks in the investment world still, both macro and to an extent now valuation risks, given how we've gone up over the last few months. There's certainly no material overvaluation in the equity markets as a whole, but we need to be sensitive to areas that have run quite hard or markets that have done well. So that's an issue potentially. As I mentioned, we have taken some equity risk off the table though in order to mitigate that risk. Presidential elections in the US are coming up. Fiscal cliff, leadership changes in China. So although there's reasons to be positive given this extraordinary policy response in much of the developed world, which we saw in the last couple of months, and notably QE3 in this month, we mustn't forget the risks that are out there.
James, thank you very much for your time.
Thanks, Richard.